Was really good, was really good. We back at it again, you feel what I'm saying? Got a new video, no more of the beginner guide stuff. That was kind of just a reboot of my older videos and to help out with specific things that most beginners need to focus on instead of trying to, focus on this, that, and the third and realize that there's only a handful of things you need to focus on right now. You feel what I'm saying? So you're not going through your journey mad confused, trying to focus on the more advanced subjects. You need to focus on, the not so advanced subjects and then move forward to the advanced subjects. You feel what I'm saying? But in today's video, as you can see by the thumbnail and the title, I'm going to be going over liquidity concepts within my own quote unquote strategy based on terminology, essentially. Which are going to be primary liquidity and standard liquidity. I'm going to be going over what is liquidity, how to mark out liquidity, what are the primary liquidity points, what I call primary liquidity within my strategy, which are the higher time frame liquidity points, so the daily and the 4 hour, and then standard liquidity, which are the minor liquidity points like the 5 minute and like the 1 minute. You feel what I'm saying? So I'm going to be going over all that and obviously also going over the difference between liquidity and a break of structure. You feel what I'm saying? Because I got some people that were asking me about that, and I know some people can get confused. I used to be confused. I used to mark out every single high point as liquidity when in all reality, that's just a break of structure. So again, I'm going to be going over what is actual liquidity and how to mark it out properly, so then you know what's actual liquidity, so then you can avoid getting caught in a reversal and understand what price is clearly seeking to get to. So let's get straight to it. All right. So, what is liquidity? Liquidity is money based on highs and lows within the market and within market structure. More in depth, liquidity is also going to be your stop loss because that's the money that gets taken out of you, your bank account, et cetera, that gets funneled into the market, which is why the markets are so influenced to take out liquidity. That's why, as traders, the more experience you get, you realize that it's true that the market only seeks liquidity and balance because without balance and without liquidity, there is no structure. Structure is formed by the highs and the lows of extensions and pullbacks based on price trying to fill in imbalance and take out liquidity points. Okay. Now, how to mark out liquidity points is going to be based on the highs and the lows within the market. Obviously, within stocks, we have gaps, so it's going to be a little bit different to an extent, but you're going to be marking out the highs and the lows within an overall arrangement. Okay. Now, that doesn't mean every single high and low is liquidity, only specific highs and lows are liquidity, which is why I'm making this video because I did have some questions recently just asking about that, et cetera, et cetera. And I used to make the exact same mistakes when I was a beginner. So if we look right here, let's full screen this. Prices forming higher highs and higher lows. This is the 5 minute time frame. And then boom, it makes this high before pulling back a little bit. I used to, and some people, mainly beginners, believe that this would be liquidity. I used to mark this out as, I would call it, I think it's sell side liquidity, or I'm sorry, sell side liquidity, buy side liquidity, whatever. And essentially, I would mark this out as liquidity. So whenever price breaks it, I will try to short it just to get eventually stopped out because this is a continuation within structure, quote unquote, a break of structure because the structure is pushing to the buy side, forming higher highs and higher lows, meaning price breaking this high point is simply just a break of structure. Okay. Now, this over here would be liquidity. And that's because its overall direction is to the sell side. Now, the highs and the lows that are actually going to be liquidity are based on market structure, meaning when price is bullish, when we're forming higher highs and higher lows, that means liquidity is going to be at the low points. And then when we're moving to the sell side with bearish structure, forming lower highs and lower lows, that means liquidity is going to be at the high points. Okay. Meaning, because this is trading stocks, this market open right here, that is going to be a liquidity point. That is the high point because this is the daily high. Okay. And then right here with this pullback, this little high point, this is going to be liquidity because we are ultimately moving to the sell side. Okay. Now, what's next to be liquidity? We got some minor liquidity, probably like 1 minute liquidity. All right. And yeah, so those would be our liquidity points within a relative area because we are moving to the sell side, meaning the lower high points are going to be the liquidity points, not the lower low points. Price needs to break the lows to continue in its overall direction or break the highs to continue in its overall direction. Now, when price is pushing in a set direction and starts slightly reversing with its overall structure, That's when these low points or the high points become liquidity. Because as we can see here, we were pushing to the sell side and then we formed a higher low and higher high, meaning we're shifting to the buy side before price manipulated, taking this as liquidity. Because this became liquidity the moment we started forming buy side structure within a sell side direction. Okay. So again, liquidity is going to be based on structure. If we're forming lower highs and lower lows, then that means in a sell side direction, then that means the lower highs are going to be liquidity, because those are the areas where we're going to be placing our stop losses, because price should respect structure and it shouldn't break that lower high. And the lower lows are just going to be a continuation or a break of structure whenever price breaks it. But if price starts reversing its overall structure by forming opposite lows and opposite highs, so in this case we were bearish and then we started forming higher lows and higher highs, then that low point becomes liquidity, only because we shifted structure. Okay. And we don't have to shift structure completely all the way to the buy side. The moment we start forming higher highs and higher lows in a sell side direction, we've already shifted structure. Meaning at that point, if price gets manipulated like it did here, this is now going to be treated as liquidity, as we can see here, which fueled its overall continuation to the buy side. Okay. So again, liquidity is based on market structure. If we're in a bullish market, then that means liquidity is going to be at the low points. And if we're in a bearish market, that means liquidity is going to be at the high points. In a bullish market, the high points, price breaking that is simply a break of structure, a continuation, because the market cannot continue in its overall direction if it doesn't break the high points in a bullish structure and respect the low points. And vice versa with the bearish structure, cannot continue respecting its bearish structure if we aren't breaking the low points and respecting the high points. Because if we break the high points or the low points in a bullish and bearish structure, then we're no longer pushing downwards. We're not moving in a downwards channel, as we can see here. We are moving upwards or we are moving downwards. Okay. And then again, levels like this, when we started pushing bullish, this isn't liquidity. This is a break of structure because we are pushing with a buy side direction. Therefore, price breaking this high point is a liquidity. This is price trying to continue its overall bullish structure after forming higher highs and higher lows. Okay. But what does become liquidity after price breaks that higher low is right down here, which is why after price took out that low point, we ultimately started pushing very big bullish to the buy side. Okay. And then everything else, liquidity to the buy side is going to be down here, 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 and here. Okay. So now that we understand how to mark out liquidity, what is liquidity and what isn't liquidity, and understand that liquidity is based on structure, and we understand structure, of course, meaning liquidity is only going to be based on certain specific areas based on structure. And now that we also know what becomes liquidity when price starts reversing in its overall direction, now we need to move to what I call my primary and standard liquidity strategy. Now, I call it primary and standard liquidity because there are primary liquidity points that market clearly and only wants to seek out, because those are the biggest liquidity points because they have the most money. The market wants money and it wants balance. That's why it only seeks imbalance and seeks liquidity. It doesn't care about your supply demand, doesn't care about your support of resistance, doesn't care about your trend line, doesn't care about none of that. It cares to fill in and take out liquidity and imbalance, because if price doesn't try to fill in imbalance, then there's no balance within the market. And if price doesn't try to take out liquidity, there's no money fueling the market within its overall direction. Okay. And the biggest points that the market is going to try to seek out are the daily highs, lows, and the 4-hour highs and lows, because those are going to be the biggest liquidity points within a relative area that are going to have the most money, meaning price is going to move the most vigorously towards those directions and most likely have a better chance of having a very vigorous reaction in terms of a reversal or maybe even just a pullback. But there's also the chance that price can also continue after breaking it. Okay. That goes with any liquidity. And then standard liquidity is going to be lower time frame, 5 minute, 1 minute, just regular highs and lows, as we can see like over here, unless it's an equal high and low. Equal highs, lows, 4-hour highs, lows, and daily highs and lows are what I call primary liquidity, because equal highs and lows, guess what? When price makes equal lows and equal highs, that's double the stop losses, double the money, because now you already had. So let's say this were equal lows. We already had stop losses all the way down here, but price doubling up means we have even more stop losses, meaning price is going to move even more vigorously to take out that liquidity point because it's going to be double the money. Okay. Now, how do we mark out primary and standard liquidity? Granted, within stocks, it usually isn't a gigantic move. Essentially, it's usually all within a relative area. So you can mark it on like the 5 minute as long as you know what's actually a daily high and low and a 4 hour high and low. But the easiest way and the best way would to go down to the daily time frame and the 4 hour time frame. Okay. So daily time frame, each candle is a day's high and low point. Okay. This is where we're not really going to be marking these out based on structure. We're marking these out based on the candle because we're in a daily time frame. These are going to be the relative highs and lows within a relative arrangement. So how I properly mark out these high points, I only mark out the ones in a relative area. Way too many people mark out every single daily high and low, every single 4 hour high and low, every single standard liquidity point. You only need to mark out the ones within a relative area, because the moment you start marking out the liquidity points and the higher time frame liquidity points far out, you end up clogging up your screen. You don't know what you're looking at. All right. So we're gonna mark out that daily high. We're gonna mark out that daily high, and then we're gonna mark out this daily low. Okay. Not really worried about that daily low. Actually, price already kind of tapped into it, so I'm not worried about that. Anything else within a relative area that price could actually get to within a day? Okay, we'll mark out this point, and we'll mark out this point over here. Okay. These are going to be the higher time frame primary liquidity points within a relative area that price could actually try to seek out. We'll even mark out this low point. Screw it. All right. Meaning, if we see price moving vigorously to the sell side, guess what? We have multiple daily highs for price to take out. And that's going to be one of the biggest liquidity points. Okay. Or if we see price moving vigorously to the buy side, the same thing. We have tons of buy side liquidity. We have tons of primary liquidity points within the daily highs and lows. Therefore, we can expect price to push bullish, that bullish, to get to these levels in these areas. Okay. Now, from there, we're going to drop to the 4 hour. This is where we're going to mark out the 4 hour highs and the 4 hour lows. Okay. And we're also going to change the colors of these just so we know what we're looking at. All right. So we got that 4 hour high and low. We'll clone this if it'll let me. We'll mark out that high point. Beautiful. And then we also got this older 4 hour high and low over here. Beautiful. And then that's just the daily high over here, making this another 4 hour low, which price is already respected and tapped into. So not worried about that. So now we've marked out everything within a relative time frame, we're going to drop down to the 5 minute time frame. Okay. This is where we're going to make sure everything is marked out properly. We got our 4 hour lows and highs marked out properly. Beautiful. I think this is actually equal highs. Yep, we got equal highs right there. So that's another big liquidity point. Okay, we already had stop loss within the general area. Now we just doubled up, meaning this is going to be a pretty big liquidity point. We got a 4 hour low here, daily low right there. We got an older daily low right over here. And then we got an older daily low all the way down here. I do not expect price to get there within a relative time frame. I can expect price to get to maybe this 516 if it went to the sell side, but that's about it. And then over here, we got our 4 hour low point right there. Yeah, we got a 4 hour low point right there. Price could treat that as like a quote unquote resistance area. So that's the only reason why I'm gonna keep it marked out. And then we have another equal high point at this 4 hour high all the way up here. Then we got our daily high right there. And then we got an older daily high all the way up there within the relative space. All right. So now we have all of our primary liquidity points marked out. Now, based on pre-market, these 4 hour highs and lows are most likely already going to get taken out. Maybe even this 517, this daily low. So 4 hour highs and lows just within stocks, I don't really mark them out as much because they tend to be within an area that's just like, I wouldn't really consider it liquidity. And chances are pre-market's already going to deal with it. So I'm not even worried about it. But ultimately, we have our primary liquidity points marked out. We have this overall arrangement. Okay, we are within the range of these daily highs and lows. Whichever way price decides to push vigorously based on pre-market and market open, we already know which price is clearly trying to seek. Let's say we push bullish, we're going to look to seek to take out this 4 hour high. We're going to clearly seek to take out this daily high. And if we push up even further, guess what? We also have the gap to fill in, and we also have a 4 hour low to quote unquote tap into, and then some other liquidity points above. So we have reason to believe price will push bullish amongst structure. You don't want to just go strictly based on, oh, well, there's more liquidity over here, there's more this, than the third. Structure. Which then if we look at that really quick, if I even did that correctly, I don't think I did. There we go. Structure-wise, we formed a higher low, meaning we can expect price to push vigorously to the buy side. Amongst the structure that we have, structure-wise, we should expect price to push up vigorously to the buy side, especially with all the liquidity above and the imbalances to fill in, et cetera, meaning we can expect QQQ to push pretty bullish coming Monday. All right. Now, these are our, again, primary liquidity points, the big liquidity points that the market's going to try to take out because these have the most money within a relative area, okay? Now, we also need to mark out our standard liquidity points, our smaller liquidity points, our lower time frame liquidity points that price is going to try to take out, not because, oh, it's so much money, no, but because, yes, there is money, but also to feel its overall manipulation and move to the actual big liquidity points, okay? So we'll mark out that low point, we'll mark out this high point right there. This is probably 1 minute time frame liquidity. Just looking at the wick size, probably had like a slight pullback. We can drop down to the 1 minute really quick and see. As I expected. Actually, no, it's not. But we do have a little some right here though. Nah, we ain't gonna worry about that. We ain't gonna worry about none of that. All right, then. Anything else within a lower time frame perspective? We'll probably drop down to the 1 minute because there isn't much 5 minute liquidity that hasn't already been taken out. Which boom, right here, we got a 1 minute liquidity point right over here, and then we got another 1 minute liquidity points right over here. All right. Now we can pull this back to the 5 minute time frame. All right, then. So this is all the liquidity that we have to the sell side compared to all the liquidity that we have to the buy side. Now, what we can expect if we see some bearishness in QQQ because of how close on how relative all these liquidity points, we can see price dip down to take these out just to feel a big move to the buy side, which would be great. I would love to see that on a break above this 522.88, and I would love to take it to the buy side. So if that's what QQQ does, I just gave you free game. Go make a bag. But yeah, so these are our primary liquidity points, daily highs, lows. These are our standard liquidity points on the 1 minute and the 5 minute time frame. Therefore, when market opens, we have all of our liquidity marked out, meaning if price is moving vigorously in whichever direction it wants to, we have a good and general area and understanding of why price is moving there and where price is going to continue pushing towards. Okay. Now, structure wise, and on top of that, this gap over here not being filled in, I very much see QQQ pushing bullish and forming another higher high and trying to fill in this gap. But I could also see price dipping down to take out this liquidity to manipulate all the way back up to the buy side. All right. So let's run this back down really quick. Okay. Liquidity is money. Liquidity is your stop loss because that is the money that the market's going to try and take, quote unquote, to add to its overall manipulated move. Again, over here, you're in a trade. Price pulled back and tapped into that little fair value gap over here. Okay. You enter into it. Maybe you right around here. You put your stop loss right up here. Okay. Let's say you're trying to take out that daily high. Actually, no, I'm sorry. That daily high is right over there. So whatever. Well, let's say there's a daily high all the way up there. You have your stop loss right there, and then boom, you barely get stopped out. And then price ends up pushing all the way up in your direction, hitting your TP. You would have made a bag, et cetera, et cetera. Okay. This is the money, your stop loss. Price manipulated to the sell side to take your money, to take out your stop loss, to fuel its big move to the buy side, because that's what the market does. The market manipulates to do whatever it wants to do. The market's going to manipulate to the buy side and the sell side to take out liquidity, to fill in inbound, so then they can fuel an even bigger move and an even bigger reversal into a said direction. Okay. Which is why understanding liquidity, understanding how to mark out liquidity, and understanding the primary liquidity points that the market will actually try to seek out is very, very important. Because if you're over here trying to mark out these high points in this bullish direction as liquidity, you're going to try and try to catch a reversal. You're going to see a slight wick within this candle, and you're going to try and freaking short it. And then guess what? It just keeps pushing. It keeps pushing. It keeps pushing. Okay. You need to understand how to properly mark out liquidity. This became liquidity. And then price ultimately tapped into it, quote unquote, swooping it out, treating it as like a resistance point at that point, essentially. All right. And then again, primary liquidity, standard liquidity. Primary liquidity is going to be the higher time frame, the daily and the 4 hour. I don't really care too much about the 4 hour because again, the 4 hour usually gets taken out by pre-market. But primarily, you want to focus on like the daily highs and the daily lows within a relative arrangement. Do not mark out every single daily high and low within the charts. Mark out anything and everything within a relative arrangement, a area where price could genuinely get to within a day. Okay. Price isn't going to genuinely get all the way down here to 509.3 in QQQ within a day. I would be very surprised if price did that. The only reason why it would do that is if FOMC came out or if some big news events came out and pre-market was all the way down here. Otherwise, within a relative arrangement, unless there's high impact news, FOMC, whatever, price is not getting all the way down here. This is why this would be considered quote unquote irrelevant. But this 5.615, 5.1615, I can see price getting there within a day. This 526.46, I can see price getting there in a day. This 4 hour low point right here, which price will probably treat like resistance, I can see price getting there within a day. You feel what I'm saying? All the way up here, I'd be very surprised, but price could possibly get there within a day. But overall, within the relativeness, I can see price getting within this overall arrangement. If it doesn't fit in your screen, then it ain't meant to be. You feel what I'm saying? Anything within a relative space should ultimately fit within your entire screen, as you can see here. Okay. Now, obviously, there's going to be more to mark out, like gaps and such and whatever. But right now, we're focused on marking out the liquidity. Okay. Um, and yeah, so again, not every single high point and low point is liquidity. It depends on the structure. If we're in bullish structure, the high points, price breaking these high points isn't a liquidity sweep. It is a break of structure to continue its overall direction. Because if we're in a bullish market and we don't break the high points, then how are we going to continue pushing bullish? And vice versa. If we're in a sell side market and we don't break the low points, then how are we going to continue pushing bearish? Okay. Meaning this is a break of structure to continue its overall bullish direction. But price dipping down here, that's a liquidity sweep because this became liquidity not after price made the low point, but once price broke this high point. Okay. That's another thing that you need to watch out for. And that's the last thing I'll talk about is just because price makes a low point, like, or let's say like a low point right here, this doesn't become liquidity until price creates structure. Yes, price had a pullback. That's beautiful, but this isn't anything until price breaks structure. And then flip it to the sell side. This high point isn't anything until price breaks this low point. Okay. So again, not every single high and low is liquidity. Only specific highs and lows based on structure are liquidity, whether that's high time frame structure or lower time frame on like entry time frames, like the 5 minute. Those are going to be the highs and lows based on structure that you need to watch out for because those are going to be the liquidity points while others aren't. Okay. And then, like I mentioned earlier, this doesn't become liquidity until price creates structure. So price pulling back and then forming bullish structure, showing a slight reversal within this downwards trend. Now this became liquidity because we started shifting structure, meaning this is now liquidity because people are putting their stop losses below here and below here, meaning boom, liquidity was taken out. This wouldn't be considered liquidity if price pulled back and then broke it originally. That would be a break of structure, and this would become liquidity, okay? But because we ended up shifting structure to the buy side by forming higher lows and higher highs, now this became liquidity, including this low point, because we created structure and an overall reversal, and we created structure, period, over here. And that's why price got manipulated to take out these liquidity points. All right. Yeah, so if you need to slow it down, run it back. I have a free mentorship, so I can teach you this personally for free on a video call, and my Discord is completely free as well. All that stuff is in my link tree in the bio. Everything is free. You feel what I'm saying? So there's no risk, and et cetera, et cetera. And yeah, go tap into it, especially if I may have forgot something, or if you just want one-on-one training and a better explanation of all of this. All right. And And yeah, so that's liquidity for you. That's how to properly mark out liquidity. That's also a brief gist of my overall liquidity strategy terminology wise, which is primary liquidity, which is the daily highs and the 4-hour highs and low points, the bigger liquidity points that have the most money that the market will actually try to seek out and take to fuel even bigger moves. You feel what I'm saying? And then how to mark out the standard liquidity points like the 5 minute, 1 minute, all those lower time frame liquidity points. You feel what I'm saying? And equal highs and lows. You feel what I'm saying? Again, the market wants liquidity and it wants balance because the market cannot move and continue structure, et cetera, if there is no balance and if there's no liquidity. The market needs money to fuel its overall movement to continue within structure. That's why it seeks liquidity and it seeks balance. Okay, which is amongst the reasons why for its pullbacks. It pullbacks to do that, et cetera, et cetera. All right, and then ultimately how to properly mark out, especially on lower time frame liquidity points and even like higher time frame liquidity points, because people try to mark out, an overall break of structure as liquidity. That's not liquidity, okay? That is a break of structure because price has to continue structure by breaking the high points in the bullish market or breaking the low points in the bearish market to continue its overall direction. If it were to break the opposite points, the high points in the bearish market or the low points in the bullish market, now we're no longer pushing bullish. We're doing this. We're going down. Clear as day. You can't go up if you're going down. Vice versa. Okay? Meaning those high points within the bullish market, unless it's higher time frame, that's not going to be considered liquidity. On a lower time frame, like the 5 minute entry wise, those high points, price breaking that is a break of structure. Or the low points in the bearish market, that is a break of structure. Okay, it's the high points in the bearish market and the low points in a bullish market. Once structure is formed, that is the liquidity. So if price makes a higher high and a higher low, price needs to make another higher high for that low point to become liquidity. Okay, and if price is making a lower high and a lower low, price needs to make another lower. If price makes a lower low and then it makes a lower high, then price needs to make another lower low for that lower high to become liquidity. Okay. Otherwise, if it doesn't make a lower high, you know what that makes? A higher low. And then guess what? Price pushes bullish, just like I showed you in that example. And then those low points become liquidity. Okay. It's a whole thing, but I'm telling you, the moment you are able to truly understand that, you will open your eyes to everything. All right. And if anything was confusing, if I didn't explain anything too well, whatever, again, my mentorship is completely free. All you have to do is DM me personally. Let me know your availability. I'll match it and set something up. You feel what I'm saying? And then my Discord is free as well. All right. Hope y'all had some help. You feel what I'm saying? I'm just trying to help some people out. God bless, and I will see y'all next time.